Howdy, I'm Max Keiser. This is the Keiser Report, the award-winning docudrama that follows two incorrigible journalists through the underbrush of truth. Stacy.
What award has it won?
You know, when you put out there in the sky, you just got to keep the propellers, going.
Is that one of those polls that you always run on Twitter where you're like, hey,
Yeah.
Which is the best show on the internet? Is it Max Keiser's Keiser Report, his Double Down, or?
I have the best polls on Twitter, by far. That's Max Keiser. Follow me on Twitter. I'm trying to get to 200,000 followers, only a few thousand yet to get to 200,000. If I get there, I promise everyone that I will put out a huge shout out to everyone thanking them.
Okay, before I get into the headlines about interest rates rising in the United Kingdom, I did want to get to this Bitcoin futures contract. If you have any statement to make on it, I noticed that you're always making statements to people like CoinDesk and Cointelegraph and coin this and coin that.com. But what about Keiser Report? We should have exclusives here.
Cointelegraph is an excellent publication. They often quote me on these matters of importance. Now, the CME, the Chicago Mercantile Exchange, will be launching a futures contract on Bitcoin.
I think it's just launched. When this is airing, it's launched.
And what does this mean? It means many things. It means that Bitcoin is becoming accepted despite the negativity of the likes of Jamie Dimon, who's trying to keep the Bitcoin genie in the bottle because as he said himself, it's going to eat our lunch. He's right. This disintermediates the need for a bank like JP Morgan. But despite that, he couldn't convince the CME to not list this futures contract. And you've got a huge schism in the banking community now. Those who want to cling to the old ways, the fees, the larceny, the drug running, and those who are ready to embrace the future of frictionless transactions, very little fees, and instantaneous, non-settlement dates like our friend Patrick Byrne at Overstock.com, who's leading the pack. He's going to put the New York... Anyway, I'm getting to the point. I see you saying, what about the point? What about the point?
Get to the point.
What about the price? I can see you. You're drooling. You're like, the price. Just give me the price action.
No.
I don't care about the facts, the figures, the economics, the architecture, the price discovery mechanism. Just give me the price. You're like a price junkie. You're on there like, give me the price. I want the price.
Okay, so what about the futures contract? One of the CME guys, I forget his name right now, but he came out and said actually Bitcoin is not a cryptocurrency, it is a new asset class.
Yes.
So what will a futures contract, what is a futures contract? What will it do to the price and to the asset class called Bitcoin, this new asset class? Some people have been tweeting me, asking me for your opinion about what will happen in terms of we know that the futures market for gold and silver, we know that it's caused, there are naked shorts there. You mentioned Patrick Byrne at Overstock.com has a new T0 platform where basically you won't be able to do naked shorts. So what do you think about a futures contract in terms of what will they be able to do naked shorting now that it's not, they don't have to deliver any Bitcoin, it's just they have to deliver more paper. So can it cause price action, like a pressuring down? Can it do that?
Okay, you make a point there about it being cash settled in dollars and not in Bitcoin. So like the silver and gold market in their futures contracts, it's used to keep the price cheap, keep the price low by using naked shorts in the paper market. So is that a risk? Yes, it is. What will be the mitigating factor to thwart the evil banksters and their naked shorts? Will be overwhelming demand.
Yes.
Because as the banking system, you see, this is the Trojan horse. As Bitcoin becomes more accepted, banks are collapsing. Their ability to get themselves bailed out by the Fed is winnowing because there's only so many dollars the Fed can print before they put the entire dollar fiat currency matrix at risk. And so they're out of runway. The banks are sitting on balance sheets that are insolvent. Every single major bank in the world is technically insolvent. They cannot pay the debts. They will never pay their debts. And if the Fed stops giving them free money, they will all declare insolvency immediately. Therefore, the demand for Bitcoin, no matter how many frickin' naked shorts they stick out there, is going to kill the naked shorts. And that's why it's important for everyone. Like I'm talking to you, Indian people in India, forget gold. It's not helping you. Open a Bitcoin wallet, start buying Bitcoin, get rid of gold, buy Bitcoin, and this will help us defeat the banksters, the banking terrorists, the evildoers like Jamie Dimon, Lloyd Blankfein, and the rest.
Actually, I saw a chart, the latest out, about the average consumption of gold per capita, and Germans are the biggest buyers of gold.
Well, of course.
The people of India.
The Germans are biggest buyer per capita.
Yes.
But yeah, they like to buy big bars of gold and stick it in their safe and go down and put their lederhosen on and drink a few beers at the Oktoberfest and talk about other gold bullion. But the Indian people, they're not like this. They're buying like a $20 chotsky at the market to prove that they're worthy to be married or whatever, or trade a couple of goats. But they need to get rid of that whole gold-based economy and move over to crypto. They, airdrop 1 billion phones onto the continent of India so they can get those wallets going. Like Africa. Africa's zooming ahead. Africa's going to be a crypto powerhouse. Africa's going to be the 21st century winner in the crypto world because they're already on the mobile phone. They're already exchanging and dealing on cryptocurrencies. They're already light years ahead of America, Europe, India. It's Africa, baby. That's why I'm thinking about moving to Africa, because I want to be part of the revolution in Africa.
Okay, but let's move to the United Kingdom. This is the nation of much debt and one obsession only. What does Britain do but housing bubbles? Everybody there, no matter what you try to do, no business exists except for the property ladder. That's the only story, nothing else, no other financial story, no other business can you set up there, no conversation can you have that it doesn't lead to the property market.
Yeah,
That's
you can
it.
talk to a British person and say, your family was just kidnapped, they've been set on fire, your yacht has been burnt to the crisp, and you've just been discovered to have herpes, and they'll be like, well, how does this affect my property? Will this mean my house go up in value? That's all they think about.
Yes, and if you ever have lived in Los Angeles, like you and I have separately, everybody there, from your waiter to your doctor to everybody has a pitch. They're selling some script. They have some script. They're working on some script.
It's a one industry town.
It's a one industry town. The entirety.
But we weren't living there separately by choice. We hadn't met yet. It sounds like we separated, and we're living in Los Angeles, having separated.
Okay.
No, we hadn't met yet. You were living in different time periods. Timeline was different.
Time periods, like a different era. I was living there in the 19th century. You were living there in the 20th. So let's turn to this headline here about the United Kingdom, because over the past week they did raise interest rates to 0.5% from 0.25%. So interest rate rise to cause some pain, says bank deputy. The rise in UK interest rates will cause some pain for homeowners, but should be kept in context, the Bank of England deputy governor has said. Ben Broadbent told the BBC that the rise announced last Thursday was moderate and that interest payments on debt were still at record lows. This is the more interesting stuff is what comes in the context, the content of these stories, because first of all, they highlight that it's the first rate hike in 10 years, which is remarkable, right? It also says that only 4 million households in the United Kingdom face higher mortgage interest rates because it's only actually 30% of households have a mortgage on their property. Most people they own their property outright in the United Kingdom after decades of living in it.
Well, the ECB's not going to help them bail out these banks because they did the whole Brexit thing. So the ECB is going to thumb their nose at Mark Carney, Bank of England, and the UK and say, you deal with the inflation that you now inherited because you're so frickin' stupid to vote out of the biggest trade bloc in the world and try to go it alone, even though that 16% of your GDP depends on trade with EU versus like 7% for EU versus the UK. They went to a gunfight, not with a knife, with a wet noodle. I mean, they got more wet noodles than Harvey Weinstein in a car wash. And they're trying to get this interest rate policy sorted. They'll never get the interest rate policy sorted because they kept it low. They engaged in financial repression to keep Barclays, HSBC, Lloyds, RBS, 4 insolvent banks. keep them from declaring insolvency because we're aristocrats and we don't hew to the law. We don't need to participate in society because Margaret Thatcher said there is no society. So we're the 4 big banks in the UK and we don't have to obey the law. And even though we're sitting on hundreds of billions of pounds of unpayable debt, we just crank out the money from Mark Carney and the Bank of England. Oh, we like the free money. And now they went Brexit and the EU will be like, and now they're going to have to declare insolvency. They're going to need IMF money within 5 years in the UK. I predict within 5 years, they're going to need a bailout because they're so stupid. They got that little Georgie guy. Hi, I'm Georgie. I'll be the king. Make him the chairman of the Bank of England, and you'll have the same results as having some frickin' dirtbag like Mark Carney.
Okay, so the remarkable things I'm going to talk to you about. This was the first interest rate rise in 10 years. So 10 years, the economy is still just struggling. 10 years, they need the free money. On top of this, the article from the BBC points out savers will see a modest lift in their returns, although Barclays, HSBC, Lloyds are yet to announce they will pass the full rise on to its customers.
They'll increase their fees.
Yeah.
Okay, they're the Jimmy Savile of banking.
Okay. So
that's what the UK thrives on pedophilia. Okay. I'm sorry.
So,
that's just the truth.
So let's move on to the next headline because this is a headline. So they haven't announced whether or not they'll pass on the full rise to their customers. We know, of course, they won't pass on the full rise to their customers because they never pass on the cuts to their customers on the other side in terms of their credit cards. The credit card interest rates are still up at 15 to 25%. So let's look back. However, I want to turn to the fact of one of our frequent guests here on Keiser Report is Steve Keen. He's a heterodox economist,
He's a heterodox sexual.
Yes, he's not in the mainstream. He's told you here on the Keiser Report that what matters most to the stability of the financial system is the rate of increase of debt in the household sector.
Yes.
So this is an article from The Guardian just a few days before the interest rate rise. Surge in UK consumer borrowing fuels likely interest rate rise. The pace of annual consumer credit growth was 9.9% last month, according to figures from the central bank, as borrowing on credit cards, overdrafts, and unsecured loans jumped. This is part of the reason why they increased interest rates by 25 basis points. But remarkably, this was down from the year before when the annual growth rate of unsecured credit was 12%.
Yeah, stagflation, and it's a nightmare. But I'm loving it because they are all idiots. Well, we got to go to the break. Don't go away. Stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to return to our guest, Dave Collum. He's a professor at Cornell University who writes a year in review at Peak Prosperity and Zero Hedge. We'll get to that in a moment. Dave, welcome back.
Hey, thanks for having me back for a second segment. Usually they leave me at the curb.
Yeah. Well, Dave, we were chatting. You have an interesting resume. You've combined your interest in science, organic chemistry, or hard science. You're also well known for your observations in the economics field, something of a soft science, like psychology or sociology. So my first question has to do when these two worlds collide. For example, going back to the long-term capital management crisis, you had a bunch of quants, mathematicians and smarty guys who took a very hard science approach to money management, that they had figured out risk and they were absolutely going to beat the risk, and they were going to deliver these outsized returns. And then, of course, they blew up spectacularly because they didn't understand the psychology of markets. Is that a fair characterization? What are your thoughts on that?
Well, the long-term capital management guys fall into the category of loosely. I actually just wrote a chunk on this called Goodhart's Law, where it basically says any time something becomes popular, it no longer is useful. It's more specific than that, but I use it that loosely. And so these guys, I think, got a good idea, and then they leveraged it up so much they became the market at some level. And the same thing happened with, you remember the old Janus tech funds where they were owning, 30% of a .com, so they couldn't liquidate their positions if they wanted to. And so actually, I think this year the topic du jour is to talk about how indexing has now become an example of Goodhart's Law. At least that's the argument I'm going to make this year, is that it was a great idea that now is too popular and become a bad idea potentially.
Right. Now, when I was working on Wall Street in the 80s, we had something called portfolio insurance, which meant that people could buy stocks with reckless abandon and have very little downside because the portfolios were insured. And then you had the crash of 1987 when that whole model broke down, and you didn't hear about that for a while. The current market is trading at above 23,000 on the Dow. There's a belief out there that risk management is very robust, and that we won't see any significant downside anytime soon. What are your thoughts there?
Yeah, that's a crock. So great stories coming out of guys like Jesse Felder and a guy named Steve Bregman, who I didn't know until this year. You look at something like the Triple Q or the Russell 2000, and they have reported price earnings ratios of 20, 25, and you go, well, okay, for growth companies, that's not a bad price. What Bregman points out, what others have pointed out, is that the way they get to an average PE of 23 is they take any stock above 40 and they round it down to 40, and any stock with an earnings that are negative, they round it to 40. And Bregman does this great math where he says if you take the whole market cap and all the earnings of the Triple Q, you get a PE of 87, which means that you're being lied to. So that's a pretty bad valuation. And if you use various Tobin's Q and market to GDP, price to GDP, and stuff like that, we're approximately twofold overvalued, in my opinion. And if we regress to the mean, that'll cause damage, that'll destroy pensions, that'll destroy retirements. If we regress through the mean, which my understanding of math says you got to spend half your time below the mean, it'll be a come to Jesus moment for most investors.
Refresh my memory. Triple Q again is
that's the tech index, 100 big tech stocks. And the PE gets reported by the parent company, whose name escapes me right now. But so they basically commit what looks like, from a physical science perspective, is fraud. They're just making it up as they go.
Well, once again, Dave, we have a problem with the Federal Reserve Bank that is allowing corporations to borrow at virtually no money whatsoever and make these huge acquisitions or buy back their own stock and boost earnings artificially, a practice that used to be illegal for obvious reasons. That's now been legal. So, and the mergers and acquisitions are a bit out of control. So a company like Amazon can buy Whole Foods, and it's accretive. The cost is zero, for funds is zero. It goes immediately to the bottom line. The market cap of the company goes up more than the acquisition price. So you've got this inversion of the capitalist tenets, where the risk seems to be borne entirely by one segment of society, and then you've got folks like Jeff Bezos, who has no exposure to risk whatsoever. He's just printing money, essentially, at this point, and becoming an out-of-control oligopolist. Your thoughts?
Well, for those who like trivia, it turns out the share buybacks were enabled dramatically back by a decision made in '84 that excluded buybacks from a rule that said you're not allowed to manipulate share price, but you can buy back shares. And so now, executives boost their end of the year bonuses by buying back shares. What the average investor seems to not understand is that while you are buying back shares, you're usually rotting the balance sheet. And people see some low PE, which is a stupidly simple number, right? It's a blunt-ended tool that I no longer use, actually. And what they don't notice is that there's $30-40 billion of debt lurking on the balance sheet. And so it's kind of a leveraged buyout by the creditors. At some point, the creditors own the whole company. And it's basically a financial engineering to make everything look good, to keep your job as a CEO. And so this will come to an end.
Right. Earnings are actually going down when you strip out the effects of share repurchases. So those PE ratios are wildly understated. So now, Dave, you do an annual wrap up for the markets and do a bit of an outlook for the for the next year? I think last year you were pretty positive on gold and negative on stocks, if I have that correct. That was not necessarily a great timing on that. What's your current feeling?
My current feeling is that that people who are pessimistic near the end of a market cycle look like idiots, and that the closer you get to the end, the harder it is on those who are pessimists. I actually believe pessimism in '09 was warranted. If you look at the valuations in '09, we regressed too, but not through the mean. And that's thanks to an estimated $20 to $30 trillion of backstop by central banks. That I've asked many, many smart people, did anyone predict that level of intervention? A lot of people predicted the crisis. No one saw that level of intervention coming. And right now, I think that we bears will be catcalled to the point of insanity until we're right. And then ironically, once we're right, there'll be so much blood in the street that they'll be able to gloat because it will be an unseemly mess.
That's an interesting number there, Dave. You're saying that the Fed backstopped 20 to 30 trillion, meaning that the initial TARP bailout money of 700 billion that we were told kind of expanded. It went to between 20 and 30 trillion to bail out the bankers, depending on how you account for it. The reason that's an interesting number is that the Social Tax Network, or the Tax Justice Network in the UK, published a study recently that suggested there's between 20 and 30 trillion dollars held offshore, not being taxed. And for this reason, you have and it's all coming out in these scandals, the Paradise Papers, the Panama Papers. So in other words, how can we really even begin to offer numbers like GDP, inflation, growth, employment, when 2 times America's GDP is held offshore, invisible, untaxed, controlled by these banks, and there's a whole parallel universe out there of money that no one's really paying any attention to except those that are benefiting wildly from having untaxed wealth appreciate in these spectacular gains, again, untaxed, Dave.
Well, if you look at America, if you call it America's GDP, the question I would ask is that if it is an American domiciled company, but that all the manufacturing and all the employment, all the production is offshore, does it really matter that it's an American-based company? I would argue that whatever country is providing the goods and services and making the products, that's the country that's benefiting from it. So I'm a little reluctant to consider those multinationals as American.
Right, fair point. The companies can have their taxes applied in one country. They can have their labor outsourced to another country. They can have their marketing in a third country. And we know about all this kind of machinations that go on in corporations to absolutely game the global markets in a way that is only available to transnationals, multinationals, and not available to the individual. But I'm talking about a hidden potentially $30 trillion cache of wealth that is not being taxed, that is being managed by the likes of HSBC, Barclays, Goldman Sachs, JP Morgan, on behalf of approximately 200,000 people that are making a mockery of the global economy and essentially stoking an insurrection, stoking violence by laughing in the face of these groups around the world that they've stolen from. Dave.
Well, I agree. And I think that, again, the central bank interventions cause this disparity. If you look at compensation for the high executives compared to the average schmuck in the factory, that those numbers have soared. And at some point, you end up in a let 'em eat cake moment, I think. And that's part of the underlying anger on college campuses. It's part of Antifa. It's part of all the mishaps that we're seeing. Who knows if you can blame some of the shooting on it? So what we're seeing is a system that is being shaken dangerously by an increasing sense on the part of the proletariat that it's not fair. Now there have always been people down the chain that weren't paid a lot, But I think the sense of fairness does move around, and I think right now there's a real sense of unfairness, and it doesn't even matter if it's true. The perception of unfairness will cause us trouble going forward, and which is why Trump's president, right? Everyone said, "Screw it, I'm voting against the system." Right? It was a bipartisan throw the bums out moment for electing Trump.
Right, and talk about Trump and talk about the Fed. Looks like he'll be in a position to appoint up to 5 FOMC central banking members soon. How do you see that playing out? We've got about 20 seconds.
He'll blow it.
In what way?
He'll put a bunch of money printers in the Fed.
Oh, okay, so it's Dow Jones 40,000 at least. All right, Dave, thanks so much for being on the Keiser Report.
Thank you.
All right, well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Dave Collum. He's a professor at Cornell. He's got great videos on YouTube. Check them out. If you want to catch us on YouTube ourselves, it's Keiser Report. Until next time, bye, y'all.